Is Tuesday, January 16th. We start off the shortened 4-day week with income from options weekly. And that is where we look at the setups in the market for both 0 DTE, 2 to 3 DTE, and then the weekly DTE, or income from options strategies, credit call spreads, credit put spreads, iron condor. Looking at the SPY at the moment, and it's down about 0.3%, 0.4%. The expected move coming into today, as you can see, it was a 0.5% expected move. With a little bit of high IV, but that's high compared to what we've been seeing recently. It's not high historically. We are looking out towards the end of the week, and we've got about only really a 1% expected move. So a lot of the volatility of this week was priced in coming in after the 3-day weekend. The levels today we're looking at, we've already got the SPY down to 475 pre-market. That is about 50 cents shy of what the bearish expected move was on the day. To the upside, we had about 479. On the week, we've got about 472, let's call it, to the downside, and about 481 to the upside. So those are some levels to look at. Last week, we saw some intraday volatility. That didn't necessarily mean that the market finished the day with a massive move, although it did a couple of times. But other times we saw it where it finished more or less unchanged. But also, if you had been trading intraday, you would have realized that it had been a lot more volatile than the final mark on the day. And that can affect volatility, that can affect 0 DTE volatility, because some traders are potentially getting stopped out on trades intraday. And they will start demanding higher volatility. Market makers, if they're selling that kind of volatility, they will demand higher volatility, higher prices for 0 DTE volatility. So something to keep an eye on, which is not only, like right now we're at about 0.5% 0 DTE. See like 0.8, 0.9% intraday moves, even though it might bounce or sell off and come back closer to unchanged. That's enough to also get volatility up. And then obviously, if you start seeing 1% moves every day at the close, that will get volatility higher. We've got a couple of earnings this week. To start the week, we've got like Goldman and Morgan Stanley. They were out. Those stocks are slightly lower, but that is most likely they are the tail, not the dog there. I think the market is dragging them down a little bit lower versus them dragging the market lower. Here on this chart, out towards the end of January, some of the big tech names start to weigh in, and we get to hear from all those mega cap companies, whatever they're calling that group of companies anymore that used to be FANG. Looking at the Qs, we've got about a 0.6% expected move for today, and we've already got stocks down about 0.3%. So Qs, again, inside the expected move. For the end of the week, we've got about 1.3% expected move in the Qs. And let's just pull back on the chart and kind of see where we are in space and time here. So we are, close to those highs, but just shy of them. We've been doing this sideways little flag like we did here. We're doing it again. It's a little bit more volatile day to day, but this is several weeks in a row where we are basically in the same spot that we started. On the SPX, the levels to watch this morning, this is the expected move after the open. We've got about 47.50 to the downside, 47.90 to the upside. So those are the current expected moves, and that's about a 0.4% move after just really 1 minute into trading.